A very good morning to you and a very warm welcome to the FIMM Annual Convention and Industry Education Series, better known as FIMMAC and IES 2022. My name is Anita Wu, and on behalf of the Federation of Investment Managers Malaysia, it's my pleasure to be hosting you over these next 2 days. We are glad to have you here at FIMM's flagship event, where unit trust scheme and private retirement scheme consultants, members of the investment management industry, as well as the public, come together to share, learn, and discuss impactful topics across the entire fund management industry. The theme for our virtual FIMMAC and IES this year is Reset, as we'll examine ways on how we can reset our future, ourselves, and our industry to keep up in these volatile times in the best, most efficient, and sustainable way. Additionally, the Industry Education Series, or IES, is being brought back this year to share and educate participants on the importance of investing and why it is essential to do so safely. These sessions are open not only to the general public, but they will also be beneficial to consultants who have just joined the industry. So welcome. In kicking off today's program, please allow me to invite none other than the Chairman of the Federation of Investment Managers Malaysia, FIMM, Muhammad Rizal Muhammad Sharif, to stage for his welcome address.
Thank you, Anita. Assalamu alaikum, good morning, and a warm welcome to everyone. My name is Muhammad Rizal, Chairman of the FIMM's Board of Directors. It's my great pleasure to welcome everyone to FIMMAC 2022. Firstly, on behalf of FIMM, we thank the Securities Commission Chairman, Datuk Seri Dr. Awang Adik Hussein, who will be delivering the keynote address for FIMMAC 2022. Datuk Seri Chairman and the management and staff of the Securities Commission has always been supportive of FIMM's initiatives. Thank you also for the participation of unit trusts and PRS consultants, market practitioners, and the public for making the time to participate in FIMMAC, FIMM's flagship conference and investor education event. I understand that this year we will have more than 2,600 attendees. This year's FIMMAC theme is Reset. The term Reset was inspired by the World Economic Forum's call for the Great Reset in June 2020 in response to the difficulties brought about by the COVID-19 pandemic. This initiative called for significant structural changes in our society. Under the circumstances, we did not have much of a choice. We have had to change how we operate business, how we interact, and how we educate. We may have to keep continually adapting to changes as we face the continued existence and perhaps further outbreaks of COVID. We have learned to prepare for the worst, but always hope for the best. 2022 has marked a great change in the lives of Malaysians. We transitioned from pandemic to endemic. Many restrictions were lifted, and many sectors are slowly restarting. This transition, this shift, provides us an opportunity to approach things in new and better ways, to reset as opposed to reverting with older, potentially less efficient ways. Globally, major developments such as Russia's invasion of Ukraine have caused an increase in oil prices, causing rising business costs, volatile markets, and higher commodity costs, which have impacted everyone. Increasingly, we feel the effects of climate change, where weather patterns have become erratic and extreme. We need to find a better way of doing things in this industry, like in other industries. An ethical, sustainable, and value-creating reset so we can overcome these challenges and continue to prosper. Virtual FIMMAC and IES 2022 intends to examine ways of how the unit trust, private retirement scheme industry, distributors, consultants, and investors can approach things in better and more improved ways to create the foundations of our reset. Despite the changes brought about by the pandemic and its accompanying restrictions, the unit trust and PRS industry has continued to see steady growth. Assets under management for unit trusts has increased over the last 5 years with a growth from 427 billion ringgit as at end 2017 to 526 billion as at end of 2021, showing a growth of 23.4%. We have had some dips in AUM in 2022 due to difficult market conditions, but I believe fund performance should be viewed over a period of time and not on a situational basis. Additionally, over the last 2 years, unit trust AUM grew by approximately 9.3% from 482 billion as at the end of 2019 to 526 billion as at the end of 2021. This growth is further illustrated by the fact that the number of funds have also grown from 644 funds as at the end of 2017 to 740 funds as at the end of 2021. The private retirement scheme space has also seen tremendous growth over the last 5 years, with its asset under management increasing by 152%, from 2.2 billion as at the end of 2017 to 5.6 billion as at the end of 2021. The growth in the PRS space can also be seen with a significant increase in the number of PRS consultants, which grew from 20,646 consultants as at the end of 2017 to 27,436 consultants, a growth of 32.9% over the last 5 years. Our industry not only weathered the pandemic, in fact, it grew both in AUM and in the number of consultants, which now stands at 65,000 as at August 2022. This shows consultants overcame recent challenges by adapting to the online services provided in large part by the UTMCs, banks, and distributors. As an industry, we work together to overcome the many challenges, and I am confident we will continue to adapt and innovate to overcome the challenges ahead. FIMM also quickly adapted to meet consultants' needs online with registrations, examinations, and courses, as well as in dealing with stakeholders. Going forward, we hope to implement a centralized database system where members and distributors alike can obtain industry information that is free, current, and easily accessible for the benefit of everyone. Let me end by saying that the changes in the business landscape and other disruptions will continue to happen, perhaps more rapidly in cycles and volatility than ever before. We will continue our close cooperation between industry players, consultants, the Securities Commission, and FIMM to continually upgrade our standards and skills in order to remain relevant to investors. Thank you again for participating in FIMMAC 2022. I hope we will have fruitful discussions over the next few days for us to lead to a path of reset. Thank you.
Thank you very much, Chairman Mohammad Rizal Mohammad Sharif, for your insightful opening speech. We look forward to having you back on stage later in our first panel session. Now, ladies and gentlemen, this stream will be a continuous one today, which means you will be able to tune in as one uninterrupted smooth stream. However, in order to clock in your hours for CPD points, you would need to click on the Next Session button at the bottom right of your screen after each session. Next, we'd like to welcome our guest of honor and keynote speaker, Yang berbahagia Datuk Seri Dr. Awang Adik Haji Hussein, Chairman of Securities Commission Malaysia, to deliver his keynote address.
Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh dan selamat pagi. Yang berusaha Encik Muhammad Rizal bin Muhammad Sharif, pengurusi FIMM, ahli lembaga pengarah dan pengurusan kanan FIMM, tuan-tuan dan puan-puan yang saya hormati sekalian. Pertama sekali, terima kasih kepada FIMM atas undangan untuk saya menyampaikan ucapan pembukaan pada konvensyen tahunan ini. Biarpun kita tidak bersama secara fizikal, kaedah atas talian memberi peluang kepada kita semua untuk berkongsi pandangan mengenai perkembangan semasa dan kesannya ke atas industri kita. Khususnya apa yang harus kita lakukan, reset untuk menjamin kemampanan bersama. Ladies and gentlemen, Malaysia's fund management assets have more than doubled since 2010 to 951 billion ringgit as more savings were mobilized through the capital market. It was also a period of rising asset prices, supported by easier monetary and financial conditions. Despite their strong growth, the unprecedented events over the last 2 years serve to remind us all that the status quo can shift rapidly. Today, it is a far different economic and financial landscape that we face. Rising global interest rates have tightened market liquidity and heightened volatility. This has negatively impacted net asset values. As the outlook ahead remains challenging, it is necessary to reset focus and expectations to ensure continued industry relevance and resilience. Being one of our oldest and largest market segments, the unit trust industry must, first and foremost, adapt to changing demands. The search for returns has seen investor preferences shift from conventional products towards alternative assets and sustainable and responsible investments, SRI. Going forward, this trend is likely to continue alongside further product innovation and a higher interest rate environment. Therefore, it is important that fund intermediaries continue to ensure that sufficient processes and safeguards are in place to manage risks from these emerging asset classes. Ladies and gentlemen, from a product standpoint, the SC introduced several measures to facilitate greater efficiency in fund management and the widening of their investment universe in March this year. This coincided with the move to a principle-based approach. Similar liberalization measures were also extended to exchange-traded funds, ETF, and private retirement schemes, PRS, last month. With these changes, a retail fund is now permitted to have some exposure to digital assets, investment accounts, and investment notes. This will enable individual investors to gain exposure to alternative assets. We intend to allow the same for the wholesale fund market as well. Sustainable investments are another asset class in high demand. Domestically, SRI funds have grown more than sevenfold between 2019 to June this year. Its attractiveness lies in its risk diversification benefits, as well as its ability to meet the social impact needs of investors. In anticipation of a significant growth in SRI funds, I'm pleased to announce that our training and development arm, the Securities Industry Development Corporation, SIDC, will introduce SRI certification for market professional in 2023. The certificate will enhance industry capabilities, particularly those involved in fund distribution, such as unit trusts and PRS consultants. After all, better equipped intermediaries will raise investor confidence and participation in the SRI asset class. Post-pandemic, retirement adequacy has emerged as a pressing national concern. It also presents an opportunity to enhance PRS offerings through their better understanding of investor behaviors and reduce the retirement savings gap. In this regard, the SC hosted a behavioral workshop with key stakeholders in the retirement ecosystem to discuss potential policies and possible applications of new product features. Insights from these workshops are being utilized to design pilot projects with industry players and the Private Pension Administrator Malaysia, PPA, towards nudging individuals and encouraging participation in private retirement schemes. Hopefully, these efforts will result in a future retirement landscape that we can be proud of. In addition, I would like to urge the industry to take advantage of an increasingly digital world. Investments into technology and online tools have become crucial to sharpen the competitive edge. It will also help intermediaries monitor and manage risks, as well as enhance process efficiencies to serve customers better. Ladies and gentlemen, even as the industry moves to take advantage of the opportunities, I would like to remind market intermediaries to continue to act in the best interests of their investors. The SC will not hesitate to pursue enforcement actions for misconduct and mis-selling by consultants. In fact, we have issued penalties of more than 4 million ringgit from 2020 to 2022. In terms of conduct, the SC has acted against consultants for failure to explain the unit trust fund marketed, for providing performance guarantees, unauthorized transactions on client accounts, and issuing false or misleading information. FIMM, as a self-regulatory organization, must also continue to hold bad actors accountable in protecting the rights and interests of investors. In fact, 76 actions against consultants have been taken in the last 4 years. This range from reprimands to suspending their registration, as well as requiring consultants to attend training. FIMM also employs targeted supervisory inspections to identify, prevent, and deter misconduct. Ultimately, we expect consultants themselves to avoid improprieties and breaches of trust. It is also incumbent on their principal firms to remain diligent in taking proactive steps to ensure expected standards of conduct are upheld. This requires all firms to act in good faith, be fair and transparent, as well as strive to avoid foreseeable harm to investors. Ladies and gentlemen, in resetting priorities and expectations, it is important not to lose sight of where we are heading and how to get there. For the SC, the end objective is to ensure a relevant, efficient, and diversified capital market. This calls for a resilient and sustainable fund management industry, one that is equipped to capitalize on opportunities and address future challenges. Moving forward, it is essential for unit trust and PRS consultants, their principals, and FIMM to continue to take their roles and responsibilities seriously. The trust and confidence of investors depends on every one of us upholding the highest standards. With that, I wish you all a fruitful and engaging two-day convention. Thank you very much.
Thank you very much, Yang Berbahagia Datuk Seri Dr. Awang Adik Haji Hussein, for your strong message, support, and that of Securities Commissions. A gentle reminder here to click on Next Session. Ladies and gentlemen, this conference would not have been possible without the hard work of our next speaker and his entire team. Please allow me to now welcome CEO of FIMM, Kalion Leong, to welcome you personally.
Thank you, Anita. A very good morning to the chairman of FIMM, Encik Rizal, board members of FIMM, my fellow team from the FIMM as well, representatives and speakers from the Securities Commission, Employees Provident Fund, Bank Negara, SSM, FPAM, AKPK, MFPC, ICMR, and the Hong Kong Investment Fund Association. Not forgetting esteemed speakers, UTS and PRS consultants, members and distributors, and the 2,600 people who have registered for our event today. Thank you very much for your support and making this one of our biggest, if not the biggest, turnout we have had in a long time. My name is Kalion, and I'm the CEO of FIMM, and I would like to thank you again for attending our 2022 Virtual FIMM Annual Convention and Industry Education Series. I have been allotted 10 minutes to greet you hello, and I plan to say hello by sharing with you 10 key highlights over the past 12 months. So this is not in any particular order, but rather as a countdown to share with you 10 key highlights that we have done over the last 12 months. And I would like to begin on a high note. Like Encik Rizal has shared earlier, the resiliency of consultants over the last 24 months have been remarkable, and that has resulted in us seeing a net increment of consultants' numbers from 2020 to 2021, whereby there were 7,500 new consultants that have joined the industry. We would like to think of this job creation event as something very positive, and it does shed a positive light to the unit trust and private retirement scheme industry as a form of employment. Next, we have the FIMM electronic magazine. Some of you all will probably be around here long enough to remember that we used to have hard copies of our magazine called FIMM Today. And those days, we only managed to, or our subsidy was only enough for us to print out 200 copies. But thanks to this digital transformation, we have managed to come up with 6 editions of our electronic magazine since 2020, whereby we are now hitting readership online of about 50 times, which translates to 5,000 to 10,000 readership per issue. Not forgetting that for consultants who are in need of CPD points, by just reading our electronic magazine would entitle you to qualify for 4 CPD points. Number 8 on our list is basically investor education. Last year, we embarked on a media tie-up with the Sun Daily to come up with more unit trust educational contents. And from that 6 articles, we managed to garner a viewership of more than 500,000 people. And this is something that we will be doing more. We've got some BM articles in the works. So just watch this space where we are going not just on the digital front, but also on a hard copy front. Item number 7 relates to our weekly recap. Some of you all may have already seen this on YouTube, and it's happening on a weekly basis, whereby we share not just local developments in the fund management industry as well as the capital market, but also global updates. So this is something that we hope will educate not just investors, but also the public at large in terms of developments when it comes to unit trust and private retirement scheme matters. Item number 6 is on the complaints handling process. The number of complaints have risen over the last 4 years. And it's not because that there are many cases out there that have gone unnoticed, but rather because we have broadened our net to ensure that all complaints, whether it comes to us directly or indirectly or through referrals, are being addressed. This year itself, we came out with a complaint handling system that enables investors to lodge their complaints with us in a more easier manner. Item number 5 relates to the FIMM regulatory training on code of ethics. Since the pandemic, we have gone digital on many fronts, and one good thing that came out of it is this regulatory training that we have been conducting with consultants. In the past, we used to have only about 800 to 1,000 consultants who attended our training sessions. But I must safely say now that thanks to this method, this pseudo e-learning method, we have managed to educate more than 10,000 consultants. And we are in the process of coming up with more content to ensure that consultants are educated in terms of regulatory requirements required by FIMM. Item number 4 is on the FIMM Investment Management Survey. We conducted an investment management survey in 2021 to basically capture the pulse of the investment management industry post-pandemic. Okay, and from that, we have learned about the efforts taken by not just consultants, but also by our members and distributors in accommodating with the pandemic, and also to ensure that business is run as usual and investors are able to conduct their transactions normally. Item number 3 is on the Investor Financial Literacy Survey. We have also conducted an Investors Financial Literacy Survey, which is a spin-off from our nationwide survey, whereby we attempted to address 2 key issues that have cropped up by investors as to why they are not keen on investing in unit trust further, as well as non-investors as to why they feel that there are impediments when it comes to investing in unit trust investments. From this survey, it was quite evident that limited knowledge to it was one of the key issues, and we are already working with our members to ensure that there are more educational materials out there so that investors are able to get access to information to help them make their investment decisions. I think I may have actually skipped item number 4. Oh, sorry. So item number 2 is basically on the examination evolution. Some of you all may have joined the industry more than 10 years ago or even 20 years ago, where we used to have a pen and paper method in doing our examination. A lot of things have evolved thanks to the pandemic. So while prior to the pandemic we were in a computerized state, today we have gone on a virtual state. And since 2021, we have managed to provide examination facilities and opportunities to more than 30,000 candidates, which has enabled people to sit for the exam at their convenience. This thing is still work in progress, and as we learn more about the benefits of going digitally and virtually, we are trying to make this process even simpler. And lastly, I think one of the key highlights that we did within the last 12 months was on the research on unit trust schemes, fees and charges. I understand that this is an area that has always been an issue of contention with the public as well as among consultants, especially when we talk about sensitive issues like fees and charges. If you have had the chance to read this report, which is available on our website, you would understand that it's not just to address the issue of whether fees and charges are high or low, but it's also to prominently reiterate to the public and consultants on the level of services that you can expect when you pay fees and charges. So if you have had a chance to look at this report, you will see that we have clearly underlined the expectation of what these fees and service charges are for and how it can be used to address investors' concerns. So overall, the last 12 months have been an eventful one for FIMM, and I foresee and I also promise you that within the next 12 months, we plan to set out to do more things for the industry and with the industry. Thank you very much for everyone's support, and I hope we all have a very productive session these next 2 days.
Thank you very much, Kalion, for your informative speech, warm welcome, and for gathering all of us here today. Congratulations on the largest turnout yet today in a long time. And indeed, thank you to each of you for your attendance and participation today. Here's a gentle reminder to click the next session button on your screen now, and after each session over this 2-day convention to clock in those CPD points. Coming up, we have our first panel session of the day, titled Outset of the Reset, the Post-Pandemic Frontier, which will begin at 9:45 a.m. So stay tuned. We'll see you in 15 minutes. Welcome back, ladies and gentlemen, and thank you for staying with us. It's now time for our first panel session of the convention, aligned with this year's Reset theme, namely titled Outset of the Reset, the Post-Pandemic Frontier. I'd now like to once again invite Chairman of FIMM, Muhammad Rizal Muhammad Sharif, to moderate the session, as well as esteemed panelists Yang Berbahagia Datuk Teng Chi Wai, Managing Director of Afin Huang Asset Management Berhad, as well as Danny Wong Teck Meng, CEO and Executive Director of Areka Capital Sdn Berhad. In context of this post-pandemic frontier, they'll be discussing the emerging trends over the next 12 months, taking into account sustainable investing, geopolitical risks, rising inflation and interest rate hikes, and how these factors affect the industry as well as investors, and most importantly, identifying opportunity in these challenging situations. Formerly the Deputy Secretary General of the Malaysian Ministry of International Trade and Industry, as well as having held various roles in Deutsche Bank Malaysia and Bursa Malaysia, and formerly Director General of Yayasan Pembangunan Ekonomi Islam Malaysia, YAPIM, it's an honor for me to hand the conference over to moderator Muhammad Rizal for the session. The stage is yours.
Thank you again, Anita. It's very kind of you to make those introductions. I have the honor today of running this discussion with two good friends, colleagues on the FIMM board, Datuk Teng and Mr. Danny Wong. Datuk Teng, as anybody that's involved in the unit trust industry would know, is the managing director of Afin Huang, and it's one of the most successful unit trust firms in the country. And then, of course, Mr. Danny Wong runs a very boutique, a very niche company called Areka that has been around for a long time and known for its innovative products. You may have read an outline of today's topic, which I actually want to try and put in a little bit of context. Or maybe fair to say that I just felt it was a little bit too wide. Given the volatile circumstances that we face and the market difficulties that we are going through at the moment, I thought I would want to refocus the attention to how it would impact our market with our industry based on our products. And that would be very useful for you. So I would like to address some questions first to Datuk Teng and then to Mr. Danny Wong. But in the questions that I address to Datuk Teng, I would like to also invite Danny for any questions that you or any comments that you may have at the end of it, if there's anything that you want to add, and vice versa later in the second set of questions. So without wasting any more time, I have these very broad questions which I would like to allocate maybe 10 minutes for Datuk Teng to start with in relation to a few key challenges that we are facing at the moment. So as we all know, the markets have become very volatile with much shortened cycles. Why do you think that this is happening? And if I can just add on to that, what are the key factors that contribute to this phenomena? And does it signal that we are likely to have a global recession in the near future? So let me pass it on to Datuk Teng, please.
Thank you, Rizal, for those questions. A very good morning to all of you. Let me try to answer those questions in a perspective of what we already have seen in the last 10 months or so, globally, what has been unfolding. I think clearly we had benefited over the last 12 years prior to this from what we then known as quantitative easing, zero interest rate policy, and the economy function, what they call a Goldilocks event, where you have low interest rates, reasonable growth, low inflation. Today, for the first time in the last 12, 14 years, we are facing a reversal of something that we have enjoyed for a good part of 14 years, especially the last 2 years. When we had COVID-19 globally, the governments had no choice but really to use both fiscal and monetary policies to support the economy. As such, there were lots of incremental spending by the governments around the whole world, and monetary conditions were let loose in order to accommodate growth. Today, as we look at the markets, as we experience, is a complete reversal of that environment. And that itself is giving rise to increased volatility, as we've seen in the marketplace. I guess we had it very good for 2 years, where prices were just rising in terms of asset prices. Today, we are going to go through another cycle where markets have to determine, there are a few things. Number one, how long will this high inflation period last? Number two, what is the outcome of it? How much of it will impact the real economy? There will be impact, but how much of it will be filtering through? And number three, there are then increasingly choices for cash. In the last 2 years, you hear people say, cash is trash. Today, cash is king again, because interest rates have gone up. I mean, it's phenomenal. You have not seen, if you are saving money in Sing dollar, in the longest time, you'll probably be paid close to 0% interest rates on your Sing dollar deposits. Today, they are talking about 3%, having 3% interest on Sing dollar. And that's phenomenal. That's so different over the last many years. I think these are things that will evolve in the marketplace, and these are things that the markets have to grapple with. The other point I'd like to highlight is that the other big risk that we are seeing, big swings in the marketplace, came around with geopolitics. Now, geopolitics is something that cannot mathematically be programmed into your systems. It causes lots of volatility because the outcomes are very binary. Whether it's the Ukraine crisis or even the recent one, the mini budget in UK, very unexpected, right? Out of the blue, we have this mini budget in UK. And what happened then? Then you realize that suddenly the long end of the bond market in UK spiked up massively. And next thing we know, unintended consequences happen. That a lot of pension funds in UK are facing margin call, arising from the swaps that they entered into in their asset liability management. And these are things that are causing lots of volatility, and I can't imagine if the UK government had not reversed some of this position. Some of the pension funds would have gone bust in a matter of weeks. And these are really real events that were unfolding that caused intense volatility in the marketplace. And I think geopolitics is not going to go away. In fact, it continues to be something that we have to keep in mind, given the heightened relationship between US, China, US, Russia, the West, and the East, and things like that will continue to play out over the many years to come. The last point I'd like to highlight really in terms of this phenomena that we are seeing in volatility is that yes, indeed, the big R word is recession. The way markets are moving in terms of what they are pricing is expecting a recession sometime in the next 6 to 12 months. The big storm is coming in. Then how do you manage your client's portfolio? How do you advise your clients? I think there are two ways of looking at it as we face such an environment. Typically, unit trust investments are meant for longer term. I have invested my own savings in unit trust, and I've decided, let's ride through the storm. Although it's painful, right? Sometimes we say it's a smarter thing to do is to sell now, buy later, but most of the time, when you try to do so, you tend to miss out the markets as they turn. The other interesting opportunities I see is really in the form of the bond funds, because we have seen, as I explained to you, with interest rate rising, we have seen yields rising in an interesting level, to the interesting levels. And today, for savers, there are now more options. In the past, when interest rates were close to zero, you only left with equity as one possible options. Today, with interest rates as where they are today, I think there are lots of interesting options on yield-bearing assets for investors to consider.
Thank you, Dato'. Is there anything you would like to add to that, Danny?
Good morning, everyone. I'm very much in line with what Dr. Ting has said. Maybe the market is pointing to more uncertainty, therefore is more volatile. And at the same time, market has gone through many cycles, and then market always in cycle, and whatever up and it will come down, whatever down, it will go back. I have not seen any market fail to rebound. So there are always, the media preaches, the doom and the gloom in the news and whatnot, But having said that, I think we have to look at beyond the short term and go for long term. Yes, there are a lot of people saying that, market is very bearish and then we will go into a recession. Well, we have gone through many rounds of this kind of disasters, and we survived each of the recessions, right? From 1975 to 1982, 1991, and 2009, we survived every crisis. And in fact, every time we went stronger, and until today, actually, index actually going higher and higher. So we have to understand about the cycle. The cycle we have been, from the accumulation stage to markup stage to distribution, and then now it's actually a markdown stage. Could be already bottom, it could be not yet, so we don't know. So we cannot predict, the recession will come or not, whether it's a soft landing case or a hard landing case. However, I think most of us actually gone through this many rounds, like what Tato say, we cannot predict what will happen. But what we can do actually, we strategize ourselves for long term. We diversify ourselves into different asset classes. Each of the scenario or market phases, we have assets to invest, and we have to sometimes ignore certain assets and go into the other assets, or we just stay the course with our strategy asset allocations and go for long term. And eventually we see our portfolio actually growing, better than we are panicked in this kind of situation. I think, the last thing I want to say is actually on this topic, is that I think the World Bank has not really come to a point that project any global recession, judging from October 2022 global outlook. But yet, I think we are all very prepared that next year could be worse, and it could be enter into recession. Hopefully, it's a shallow one and short one, then we can go back. But market always move forward, always 6 months, 9 months ahead. So we are already pricing most of the bad news. So let's see what will be after this, and whether we are actually, following the media and where always preach the doom and gloom, and then we give up hope and then sell at the wrong state, and then eventually market rebound. We miss all these things. Let's not time the market and ride on it. In fact, you could see a better future then.
Thanks, Danny. I think for most of us of this vintage, we've been through a few cycles already. It's never as bad as you think it is. Never good as people always say. One interesting thing that was raised by Dato' Teng was that there are a lot of geopolitical issues. Most of these conferences, we tend to stay away from those kind of issues and stick to market forces, but I think it's unavoidable. And there was a very interesting talk last night with Farid Zakaria, where he was talking about the differences of Russia and China, where way back when, during the Cold War, they were not major economies. But today, with the problems that they're having with the West, these are, particularly in the case of China, a major economic force. So there's a difference. I think there's concern that the friction between these countries are going to hopefully doesn't cause problems, but they predict that it's actually heading that way. Let's see what happens. I I think you have already jumped ahead of the gun, where you have asked, the audience has asked questions where, are there any strategies for fund managers to reduce the impact of inflation? How long will the global inflation persist? When you think it will stabilize? So I think some of those questions have been answered. You might want to answer the question on the impact of inflation in their investment returns. I think that's quite good. And this is the $50 million question. What do you think about the impact of the coming Malaysian elections on the Malaysian stock market and economy? Okay, so I'll put that out for both of you.
Maybe I answer the one that is easier to answer. The impact of inflation on your investments. I think what we can see is that with inflation, central banks globally that have been so slow to address it, today is trying to catch up and trying to keep their credibility, in my view. Right? They have been so accommodative in the past to believe that growth is important for them. However, they have actually slacked in controlling prices. The Ukraine crisis basically disrupted supply chain globally. And today we have seen commodity prices have gone up, and then finally it got passed through to the end consumer. There are two parts to it. The good news is that I think the disruption on supply chain is easing. We have seen it worldwide, right? I mean, you talk to builders on aluminum prices, steel prices 6 months ago, and today you know prices today are back down. Not back to pre-level, but at least it has eased and supplies are coming in. But we are still seeing that tail end of the effect of higher prices. When we have inflation, we have interest rates, what it happens is that it reprices the asset prices. That's what it does. Essentially, when we used to value companies, how do you value companies when the long-term interest rate is 2%? You can put a valuation of 30 times, 40 times, and it's still reasonable because your alternative is a 2% return on your long-term bond. If a long-term bond trades at 6 to 7%, it completely throws out valuation. Then at 15 times, 16 times, that's probably would be the fair valuation. And that's what's happening in the US market today, where the markets are repricing at the moment the valuations relative to the long-end bond that is traded at 4% today. That's how the adjustment takes place. The other point I like to make on inflation, I'm of the view, I may be wrong, but I'm the view that inflation has peaked and it's coming down. The problem is it's coming down very slowly, right? It's no longer going, I don't think it's going to rise higher than what we've seen in the middle of the year. It's coming off in US, even in US it's coming off. But the pace of decline is not what the market wanted to see. The market would like to see a much faster pace of decline. However, if you look at the core inflation in US, 1/3 of that increment came from rental increase. Now that's sticky. When you have rental increase that contribute 1/3 of the core inflation, it will take a while for that to ease in terms of the incremental contribution to inflation rate. So we have to be patient. And I think by next year, even if you have this conference again next year, you will then hear that, oh, inflation is down, Fed is behind the curve, now they need to cut rates sometime by end next year, and the market by then will adjust to economic cycle and the repricing again. Maybe then you want to take the election?
Well, right. Maybe I'll just add on a bit on the inflation. My view is very much in line also. I think the inflation is peak, and also think that the Fed cannot continue hike the rates, given that no longer those days like 1980s where the Fed rate could have touched 20% when the inflation was double digit. I don't think so today we will have this kind of scenario, because the modern monetary theory actually should take place, and then they will flood the market with money. When actually too much money, then they will just tax the market and then take back the money. This is similar to the rest of the world. So I think inflation is here to stay also because of the new changes. I think everything could be very pricey now. So back to the impact to the market, especially to our investors and even myself, I don't think so we can rely on our passive or rather our active salary alone. That may not able to catch up with the prices. Our salary increment is so slow that our price is actually gone too far away from what we are earning today. So come to a point where we will have deficit if we don't do anything. So we have to change, right? I think we have to really do for some of us actually have a second job for secondary income. Some of us actually have to make our money work better. So no longer those days that you just keep our money passively and that's it. So I think this is a key point. We have to advise our investors to continue catch up with the inflation rate by making the money work, right? So then whether recession, don't recession, the money, if you invest it in the right asset allocations, it will produce something that actually meaningful to catch up against the inflation. So we may need to be active investing nowadays rather than putting the money in a very low yield environment moving forward. So that's my view on the inflation and the impact to the market. And the tough question on the local, I don't see local politics will end by this election. You know, it will keep on develop, because we are in a developing country, and then we need to really make our political scenes more mature than, like the rest of the developed market. So we are going through the phase of maturing political scene. So it will evolve, years after years. So this round, I don't see any big event on this, whether whoever be the control the majority, right? So, but I hope there's no hung parliament. I don't think so. There will be one. So if any, there will be maybe a coalition government. But I think there will be a simple majority, and that actually make us our job easier, because one uncertainty has been removed. To me, election is a good news that at least we remove one uncertainty from whatever that is actually caused the market volatile. So once the uncertainty being removed, we are actually less by one, and then we focus on the other two or three maybe in the market. So maybe if a Fed, like what Dr. Ting said, that if Fed actually taking a stand that, oh, now maybe the recession risk is higher, we have to take care of it, then maybe slowly moderate the rate. I think that should be welcomed by the market. And then the other one is war. War is always there. Geopolitically always there, right? So we have to just be careful. But of course, this round is actually causes more damages, right? While the other factor is actually the big power like US and China, will they slow down? Now that will also impact the global trades. So this is something that we need to look at it. But I'm not very, very worried about this, because no matter how the outcome of the market, there are assets to be invested. Like what Dr. Ting said, we will be very cautious on the bond market past few years because of the yield are very, very low, right? And then they're only putting up in the future. But now we're already up. So what will be the next? So it could be down, So it could be there's an asset class that we should look at. So no matter how the market moves, we can have our strategic allocation to the right sector. Of course, we don't trying to, put everything into one basket. We diversify into a few asset class. Even equity itself, I may not be very bearish at this. I'm sanguine that there are still sectors that beneficial from this kind of environment. Like, for example, rate hike, I'm sure everybody knows that bank will benefit a lot. And then Bank Negara will maybe have to catch up with the rate, so with the next 1 or 2 meetings. So that also may give some kind of margin, expansion for some banks to make more, and then the loan growth as well. So there are sectors that will benefit from that. And the rate cut, of course, you will benefit all the high yield products, that you can capture at the yield, at the peak of the yield, and then you ride on the capital acquisition eventually. So there are always things that we can invest. There are always things that we can also advise investors to stay put with our current portfolio. So in long short, I think the rest of the factor is more important than election. I don't think so. Election will be causing a lot of things here. Yeah. That's my view.
Thank you, Danny, Dato'. I think the only comment about the elections, not just the Malaysian elections, is that markets prefer certainty. And, every time you have markets, elections where it creates more questions than answers, it may be volatile. In fact, one of the more important elections that we should maybe be taking note of is the midterm elections in the US. Because if you have the Democrats out of control of the Senate, and it essentially means that the administration for the next 2 years will find it very difficult to push economic measures across. And that has a global impact. Yeah. So yeah, we'll see what we see with what comes up with our own domestic politics. Hopefully, a more cogent administration over a period of time, rather than this start-stop kind of thing. Okay, let's move on. I have a set of questions for Danny, but I'd also like Dato' Teng to chip in if he has some additional comments on it. How will these market volatility and uncertainties affect unit trusts and the PRS industry specifically? And what advice would you give to unit trusts and PRS consultants and investors in current market conditions? I think some of that you've alluded to already. How can the investing public prepare itself to face a volatile and uncertain market environment? Over to you.
Firstly, I think the impact to the market always there, the sentiment. There are a few things affecting the market: liquidity, risk appetite. These, I think, always in short term affect the valuation and therefore affecting the market sentiment or the investor sentiment. And today there are many, I would say, noises, which is not really good, and we hear too much and read too much. Sometimes we just stick to what we believe and what we are holding on for long term. That could drive us through all these uncertainties. So sentiment is the main factor that causing the volatility and today affecting some of the investors. I think as consultants, as advisors to our investors, this round is actually a very good test for us. I quite like Warren Buffett. What he said is that when the tide goes away, then you know who is swimming nakedly, right? So you have to go through the portfolio that some of the investors are overly exposed to certain sectors, right? Then you know there are too much risk towards certain things. Then it's a time for you to go back to investors. This time you see, this is a real test. Maybe your portfolio to be overly exposed to certain type of asset class. It's time to rebalance and strategize yourself for long-term growth, right? This is something that is always good. And then, of course, don't act like an investor guru in the, some of the website and internet, right? We are not really, we are here to stay for long term. We don't disappear, when market is bad and appear only when market is good. There are some investment guru always like that. Wow, they appear everywhere when market sentiment is very good. But look at today, I think most of them disappear. We are not them. So we are here to stay. This is a time where we hold our investors' hand and go through this. I think more so, investors will like us to tell them so much of what are we going to do, not so much on what happened, right? So investors like to see us, to hold their hand and say, here, this is a strategy, move forward. This is what they want to hear, rather than say, hey, this is my portfolio negative. No, they don't. Most investors, they are all reasonable. They just want us to give our piece of advice. Of course, they will not take all, but at least they want to see what is our view and what's our strategy moving forward. So always go through this time of market. To me, I've gone through many this one around, and then it helps me. It is actually give the trust, create the trust among us, between us and the investors. And this is around that we can show that we always hear when market is no good. So when market is good, never mind, because everybody will become to be investment guru and advise everybody, But this round, not many. And this is a time that we should show that we are here for investors, right? So what investors are supposed to do, I think we have shared some already just now. I think it's time to look at the portfolio, whether not totally time the market now, right? But at least look at the risk side of it, whether we are already exposed to certain sectors or asset class, then strategize it again. It's okay to look forward rather than look backward, because looking backward, you see, wow, so many losses, then you don't want to do anything drastic. But actually, it's time to look back and know whether you have exposed certain risks. Now is to adjust again and move forward, because important is look forward rather than look backward. So some of them will say, oh, I'm too painful to cut loss, or too painful, or too fear to go into the market. It's actually not so much on timing the market, it's actually more on asset allocation, whether the outcome of this portfolio is actually suits your needs and your risk. So if this risk-reward ratio is balanced, that is a time for you to move forward with this kind of asset allocation. All right, thank you.
Thank you. Anything you would like to add, Dato'?
Yeah, I guess one of the experience I had in the last few months, fully agree with Danny that, look, this is a time for you as consultants to go out there and really advise your clients and hold their hands, to guide them through this difficult period of time where markets are volatile and uncertain. I had opportunities to meet a lot of clients during this period of time, and typically what I advise them is that really, if you can't sleep at night with your investments, then it's time to make some adjustments. If you can sleep well, then just continue on with the journey. That's the gauge I use. And true enough, the number of them said I couldn't sleep. I said, then why not make some adjustments? Now, these are all irrespective of where the markets were. And after we have done the adjustments, and when I go back when we go back for review again, after a number of months, they're a lot more comfortable that they made such adjustments. Maybe because the market went down. That's why they said, wow, I made a good decision to reduce risk. But I can say this, regardless of where the markets will be, whether up or down, because you're not going to cut out completely, you're just making some slight adjustments on the asset allocation, they'll be very comfortable, right? Because at least they know if they need to de-risk so that they can rest at night, let them de-risk, right? Then put in some fixed income or lower volatile asset class so that they can then review it as the markets unfold over the next few months. And that's what I've gone through over the last 6 to 9 months with a lot of clients.
Thank you, Dato'. We actually had a similar discussion at last year's FIMMAC, where we were talking about upskilling the benchmark strengths of consultants, and this is where your skills will become important, because as mentioned by both Danny and Dato' Teng, I mean, during the good times where everything is going up, you're just selling, right? But this is when your advisory fees are actually the advisory fees that you really need to work for. So let me just go to a couple of questions which I will direct to our panelists. What do you think our ringgit depreciating against other currency on the capital market and economy giving the increasing inflation rate? So I assume the question is about what is the impact of our depreciating ringgit. I know it's depreciating against the US dollar, not necessarily against other currencies. So would somebody like to comment on that?
Well, I think as Malaysia, if I spend most of the time in Malaysia, I wouldn't see any impact, right? But other than, of course, direct impact, indirect impact would be our goods become more expensive, especially those imported goods, right? It's by paying the same amount of dollar, but we have to make more, we have to pay more ringgit. So that's the fact of it. So imported inflation is actually is all this while we cannot feel it. Cannot be directly pinch our pocket, but you can feel it that we have to pay more for certain goods that used to enjoy cheaper last time. right? So that is actually, of course, the other thing is actually when we used to travel or maybe have children abroad, that will be the time that you feel the pinch, right? So much, especially in US, then you have to pay, from four ringgit to $1 today is actually nearly 4.7 to $1. So you will see almost like 20% increase. So that's actually, you used to pay maybe $10,000 for your children's school fee. Now to pay maybe slightly higher, about maybe 12,000. So 20% more, indirectly 20% increase. So that is an impact to us, in terms of inflation. Imported inflation, as well as you travel overseas, you feel the pinch. Of course, on long run, when you already plan for retirement, because of higher inflation, because of you need to travel the world, whatsoever, your retirement plan got to readjust a bit, because it will affect you because of you have planned it. Maybe your retirement plan could be 20 years ago or 10 years ago, and with the inflation rate is so much reasonable. Today is no longer that, so you have readjust a bit. Either you have to make your take a slightly higher risk to adjust your growth so that you can achieve your goals, or you have to cut short certain expenses, cut certain expenses so that you still maintain your retirement plan in check. That is something that you have to really look at it. So I think long short, the weakening ringgit also have some implication to our longer plan.
Maybe, Chairman, I'd like to add that I'm just thinking a very good question on how does a weakening ringgit impact inflation in Malaysia. I believe there is impact, right? I mean, Malaysia import, if I'm not mistaken, 60-70% of what we consume are imported. And when you look at imports, they are not priced in ringgit, neither are they priced in, I think predominantly all priced in US dollar, right? So by large, you will see that coming through. However, one thing that you do notice in Malaysia, why you don't really feel as much, is because we run a very subsidized economy. The government, to a certain extent, has subsidized a lot of things in Malaysia. That's why we don't see that hyperinflation numbers coming through Malaysia. Your rice are subsidized, your sugars are subsidized, your electricity is subsidized, your gas that you pump in your car, they are all subsidized. The question is really for us, how long can this subsidy go on, right? And then the question also, is subsidies a better use of the budget, or development is a better use? And the answer is very clear. Development is a better use of the budget rather than just a pure subsidy. Yes, the B40, the M40 needs help. We need to keep prices low for them. But that shouldn't apply to the T20, because they can afford to pay for it. How then do we change the system or revamp? That's for another discussion altogether. So I think we don't feel as much. It's because of the subsidies that the country runs. The other point I'd like to say is that I think where the direct impact on the currency weakness to dollar will be in the gas prices. And should the gas prices rise in any big way, transportation price will rise, and then then eventually you'll filter down to your kopi o price in your coffee shop. I think that's probably the fastest translation if I would look at from a layman perspective of inflation.
The McDonald's benchmark. Yeah, okay, so let's go to another question. And I guess this is alluding to the banks. So there's a comment, not quite sure what the question is. Banks are so strict in lending, so rigid, requesting for 2 years earnings, which is the MCO period, during the MCO period, I guess. Most housing loans failed. What's the expert's view? So basically here, I think it's asking whether we have structural integrity, the banking and finance system, particularly, I guess, when things are going bad, where there's going to be constriction in terms of consumer usage and bank loans and this kind of thing. Do you see that happening?
I think banks has been really cautious on lending to housing, consumer housing. I think that's something that we have seen not only for these last 2 years, but I think prior to that they were quite concerned of the oversupply situation. at the housing markets in Malaysia. And I think they've been encouraged by certain regulators to relax or to consider supporting the housing market. Unfortunately for banks, I believe the first and most important responsibility for all banks is to really protect the depositors. That is the cardinal rule of banking system. Should we not have discipline in our lending and the depositor starts to feel the pinch because NPL start to rise, we're going to have a big crisis in hand. It's just not about lending to individuals. So my sense is that our banks in Malaysia, thanks to Bank Negara, they have been very prudent in their approach towards lending. And despite COVID-19, when we expected NPLs to rise in a rapid manner, we hardly had that. There was some rise, but it's just very manageable. So I think, while yes, certain segment of the markets need help in terms of credit, I think we must be disciplined at the other extreme, the other end, to make sure that our system remains robust and stable.
Allow me to add something on this. I think beside bank is a proxy to economy, and the banks is actually very important to an economy. So if the banks fail, I think there will be a repercussion to the economy. I think you look at the subprime crisis, that will be a very, very big lesson to us. We are just simply lending it out to those who are not, not within the lettable environment, or those who are with a lesser or very weak credit. Then we have this issue subsequently. When small storm come in, then everybody will get affected, and those who are with a good credit will also bear the damage. So this is not what we want to see. I think it's a good thing for us to be disciplined for ourselves, being a borrower. So we build our own credit. The moment we have good credit, I don't think so bank will not lend to us. In fact, banks are happy to look for good credit guys. And then they love to say, I mean, not me, but some of our friends that with a good credit, they always get call from bank, hey, do you want me to give me, you don't even need to have collateral. I give you maybe 100,000, 200,000 kind of, personal loan without any collateral. That means that this person must have very good standing in terms of the credit with the bank. A bank loves to lend to you because they know your credit. So it's a good thing for us to, this round, or even in future, to build a good credit. When you have a good credit, you are not worried about bank to lend to you. That's a key point. And make sure that the bank continue to be healthy in this environment, so that even the recession will come, we still can survive, because the bank survive, we can survive, and we can get loans from bank eventually.
I totally agree. I think that's an even more important factor of confidence than even the elections, right? You need to have a sound financial environment. Let's go to another question, and then maybe we can wrap up, where essentially it's asking, given the assumption that we are going into a recession, how would a fund manager take advantage of it? I mean, you're basically being counterintuitive and trying to take advantage of a difficult situation.
I think into a recession, there's no doubt that most of the asset prices will decline. The question is, how do we protect the portfolio as much as we could? Of course, then you said, okay, I buy some defensive stocks. Then what is defensive stock? There's no such thing as defensive stock into a market that collapsed. Remember in 1998, during the Asian financial crisis, you thought public bank is the most defensive stock. Guess what? It dropped 70%. Now that's the type of crisis prices that we've seen. I'm not expecting an Asian crisis happening in this cycle. I'm not. I think we are going to go through a recession, and it's just a repricing of asset prices. We are used to valuations that are very high for a good part of 14 years. Today, we need to make some adjustments to those expectations. And markets may have another 10-15% to decline, and that's probably what we see, what we may going to see, right? Because of these adjustments. And there will be slower growth. There will be earnings cuts as we go into next year. But some of these are starting to be priced by the market anyway. So I think as fund manager, what do we do in terms of this type of phenomena? Is other than just really going to defensive stocks that have cash flows, try to avoid companies that are highly leveraged, and then look at cash as a buffer in the portfolio so that you can reinvest when prices are much cheaper. Then the other way of running a defensive portfolio is really from asset allocation. From your perspective, from your client perspective, is really you allocate your assets correctly. Rather than 100% in risk asset class like equity, you can then shift into 50% into equity, the other 50% into 25% into cash, 25% into bonds, and this will weather you through where the portfolio will decline in a much slower pace. I'll give you an example, right? We had an income fund that runs 30% into dividend stocks and 70% into fixed income. And I was just looking at the number, year to date, the fund dropped 6%. While it's a lot to me at 6%, it looks a lot, but actually you look at in the whole scheme of the market this year, that 6% is still a very tolerable level. If you have invested in the pure equity funds, you will probably be down, my guess is about anywhere between 10 to 15% this year. So I think that's how you defend your position, by treating the asset allocation so that the decline gets slower as the market decline.
Please.
Yeah, maybe I would like to add on to this is that actually, when we first approach a client, we understand the client's risk profile very well. And then, you know, when clients started to invest, they always say that, okay, I can take this risk and therefore I buy into this equity, right? So over time, they've forgotten about what they said. I can take this risk and then ride on this for long term. When a person invests in equity, they know that the equity tends to be ups and downs, right? And they already price in this journey ups and down in between. And ultimately what they want is maybe 15 years, 20 years down the road, I want this return. You already, as an investor, already make your mindset very well, say that I am going to ride through this long term, and then there will be ups and downs, there's bumps in between, but I'm okay because long term I want to achieve this, I want to stay with this, and I want to achieve, let's say, a 10% per annum over the next 20 years by having exposure into, let's say, an equity growth fund or equity dividend funds or equity funds, whatever is that. But then they're forgotten along the way. So we, as a consultant, we have to really remind investors, say that the moment you started to invest, you know that it's not a straight line all the way like that. There'll be ups and downs. You already prepare your mindset that I'm okay to ride through this up and down. But why you're panicking at this moment? So you shouldn't do any drastic if you can sleep, right? So you forget about that. So you buy the next door piece of land, you don't revalue it and look at it every day. You look at it 15, 20 years later to sell, or 10 years later to sell. You don't look at it next day or tomorrow or a day after, right? So leave it there if you're okay. Of course, you cannot. Then, of course, you're just a bit on your risk because then you may be, overly exposed to certain risks, right? So back to the initial questions, where I think for us, fund managers, how we can do this thing. In fact, fund manager actually know better than you and me and everyone. The only difference is actually we spend more time than you, that's all, right? Not that we are wonders, we know everything. If not, then we'll be very rich by now, right? It's just that it's our profession to look at the market, to spend time, to do more things than what you cannot do, right? So this is our job. That's why you delegate your money and with us to invest it. In this time, you know what to do, right? Whether we're buying, switch some high-risk assets to the low-risk assets, do some tactical adjustment here and there, maybe keep some cash and then deploy the cash when time is right, and then buy into some value stock that which, like what Dato' Ting said, at this moment, I'm looking at cash-rich company with good fundamentals. So if really the deep recession comes, I'm not that bad. Not that I won't lose money. I'm not that bad. But then I still have cash. I can still go into certain sector and buy value, or I still holding that value stock, because The moment I know I'm holding something that it will not collapse and one day it will bounce back even more beautifully, why should I do anything at this moment? So I should continue even if I buy certain stock at $10 today, drop to $8, make more sense for me to even buy more because it's cheaper at this moment. So our job is quite easy to look at, of course, easy in the sense that to look at the price. So we think that $10 we are convinced to buy, why not $8 if the fundamental doesn't change? Unless the fundamental change, then we swap to other stocks. That's our role. We spend time to monitor, to study those things. So leave this thing to the fund manager the moment you already dedicate to fund manager and you sleep better. That is our always the advice to investor. No worry, we know what to do because we have more time to do that than you, right? For you, just do your normal job. Leave this to us. We will know what to do.
Thank you, Danny. We have 10 minutes left. I want to thank all the questions that have been coming through the audience. Some very good questions. Unfortunately, I can't go through all of it. I actually want to spend the next 10 minutes getting down to a working level. We've been talking at macro views and what inflation will do. I would just like your take, maybe for a few minutes, in terms of what kind of work would you expect consultants to do in a very difficult time? Stick close to your clients, what advice you need to give them. Obviously, the more difficult the situation is, the closer you need to be with your clients. Maybe I can start with Danny first.
Yeah, that's actually very crucial for us and very good questions indeed. As I just now shared that actually, we have to realize that inflation is here to stay. Indeed, the real inflation is actually much higher than the reported inflation figures. And those who stay in the town area is far more higher than those who, of course, in kampong or rural areas. And we have to just look back. As an advisor, we have to look back and look at our client's portfolio, whether for example, whatever retirement plan or certain target or goals is still achievable. We have to readjust ourselves for that, right? And the other thing is actually things has changed so much with the digital economy, with actually aging population, right? And with the youngster mindset, we are very different today compared to 20 years ago. The younger generation nowadays, they're willing to look at certain things that's non-conventional. So they're more acceptant to cryptocurrency. They're more acceptant to certain, online things. They're more, they trust people from online that they know that without physical face-to-face. That kind of mentality mindset is very different from the old days like my generation, the baby boomers. The baby boomers, on their hand, still stick to what they believe in. So when we meet our client, we have to know baby boomer. So their job is actually to protect the asset so that it will not be, affected by inflation, and then the money that actually built actually depleting because of high inflation rate and low growth. So we have to look at this area. Whereas for the younger generation, more advisable is actually to diversify, because younger generation means that they have maybe not as much money accumulated unless they got inherited from their parents. But when whatever the hard-earned money, they tends to put the money into certain risky stocks. And that is something that we have to advise investors to diversify and build a long-term portfolio. Maybe it's okay for you to expose certain asset classes into the alternative assets, right? But not all in. It should diversify into something that even that one goes down, you are still okay because you still have this one. And this supposed to be, built for your retirement, for example. So always work on a diversified portfolio rather than, avoiding them or advise them not to go into other assets, because their mindset is actually they can go anyway. Why you stop me, right? But it's just that it's our role to say that, okay, maybe I'll diversify a bit. It's okay to accept this alternative asset. It's okay to go for conventional asset. Diversify. Diversify in the sense that not having 100 assets class. No. Diversify in terms of risk. If this asset class goes up, the other asset class will go down. But if the other asset goes down, you are still okay with this up. You balance your overall risk, and that's still okay with you in long run. So that's diversification. Not so much on having 100 or 1,000, that's diversification. No. It's actually the risk characteristic of each asset classes. It's one move up, the other the other thing, one move down, the other thing actually move up, then you balance up your overall risk.
I think a lot have been covered by Danny in terms of what I guess consultants like yourself and even for myself, I also and actually go down to meet up with clients. It's actually really not to disappear when times are bad. That's probably not the right approach towards this business. If you are into this business for a longer term, one positive light that I can always see about this industry is this. Most of our clients invest for the long term, right? I remember telling people this story about my grandma. That's no longer around today. But when I saw her investment in one of the mutual funds that she put 10,000, I think she invested for 15 years, through ups and downs. And she decided not to look at it until the day she's no longer around and it became an inheritance for the children. And that's the nature of Malaysians, which I think is very phenomenal that you don't see in a lot of countries, where Malaysian investors tend to invest for the much longer term for their retirement. But that said, into this environment is where we need to, if there are clients who are concerned, who wants to have discussion, I guess we have to be there with them to hold their hands and guide them through this difficult phase. Second point I like to make is that tough times like this don't last, actually. There are always brighter days in the markets. I've been in this business for 30 years. I've seen a lot more good years than bad years. If I have a lot more bad years, I will not be in this business at all, right? We have more good years than bad years. And if I'm not mistaken, out of every 10 years, we probably have about 6.5 to 7 of good years and probably 2.5 of bad years and 1 year of just not doing too much. So I believe it's still the same. There are more good years than bad years. And I don't think, just that the cycles have gotten shorter, and that's why we feel so stressful. But otherwise, over time, I think that probability still stands in my view. So I think just need to understand that we are very deep into this cycle. This is not new. This is not something that just started overnight where Fed is raising rates. They've been raising rates for a while, and I tend to believe that we are probably closer to the end than the beginning of the interest rate cycle. It may be still painful the next two cycles, the next two hikes, but we are probably closer to the end. I can't see that they will be able to raise it too much from there. And then by then you will see inflation tapering, and eventually the impact on the market, on the economy will be seen, and the market will start to price forward, and things hopefully by sometime next year should have a more normalized cycle. Thank you.
Thank you. Dato' Teng, Danny, I think we've had nearly an hour's worth of a very good discussion. I think, during difficult times when we are expecting a rough 2023, everybody in this industry will need to work harder, work smarter, and perhaps just like we began in the opening remarks, we need to start considering to reset, and particularly our sales force. So I would like to commend both the speakers. I think the comments have been really on point. I think during difficult times, this is when people really make a difference in terms of whether they are professional advisors or whether they suddenly disappear and conveniently come back when the bull market comes back. So for an industry that's been around for 30 years, I guess my only parting words will be, we need to stick close to our clients. This is the time when they need us the most. This is the time where they need reassurance. This is the time where they will need ideas for new strategies. And I'm sure our investor, our sales base, along with the unit trust companies, will be supporting each other to make sure that we meet the challenges coming in the months ahead. So with that, let me thank everyone for participating in this panel discussion. I saw very many questions. I apologize for not being able to cover all of them, but I hope you've enjoyed the session. Let me pass this back to Anita, our host for FIMMAC 2022. Thank you.
Thank you very much, gentlemen, for addressing many relevant concerns and for that insightful and wonderful opening panel session this morning. Thank you as well to our esteemed moderator, Muhammad Rizal Muhammad Sharif, indeed, as well as our engaging panelists, Datuk Teng Chi Wai and Danny Wong, highlighting the importance of sticking close to our clients in these challenging times, indeed. Thank you as well to each of you for being an active audience. Please keep those questions coming over our sessions today. Ladies and gentlemen, there will be a lucky draw at the end of the day. Now, to qualify, you need to earn your way through the lucky draw quiz by answering 10 questions, which you can access anytime today until they close the session at 4 p.m. All you have to do is to go to the virtual platform, click on Game Room, which you'll see on the top right corner. You'll arrive at another microsite. All you have to do is scroll down slightly and click on Join Game here, which is in a box in blue. There will be lucky draw prizes for only 2 winners who will win 300 ringgit cash each. Now, I don't know about you, but I'm very happy to tune in to an online convention and be able to have 300 ringgit transferred to me at the end of the day. So remember that to qualify for the lucky draw, which will be held at the end of today, all you have to do is to answer the lucky draw quiz. And those who get all 10 questions correct in the fastest time will be put into the pot for the lucky draw. So complete the lucky draw quiz under the Game Room ASAP, bearing in mind that the cutoff time for the lucky draw today is at 4 p.m. if you'd like to qualify. Only the top 30 scorers will qualify for today's lucky draw, so good luck. Next up, we have our second panel session of the day, timed at 11 a.m. It is titled Investment Behavior, Theory to Practicality. So stay tuned. Also, a gentle reminder to click on the button that says Next Session on your screen below after each session. Stay tuned. Hello again and welcome back to FIMMAC and IES 2022. It's indeed time for our second panel session of the day on investment behavior, theory to practicality. Allow me to begin by inviting our in-person guest onto stage. We have Brian Zeng, CEO of FA Advisory Sdn Bhd, as well as those present virtually for this session, moderator Dr. Joanne Young, founder of Research Impact for Singapore, Sally Wong, CEO of Hong Kong Investment Funds Association, as well as Ng Si Hao, Head of Retail Wealth Distribution of Manulife Investment Management Berhad. Now, Dr. Joanne Young, our moderator for this session, is a highly illustrious applied economist working at the intersection of behavioral economics and health, as well as financial decision-making. She is the founder of Research for Impact, a research enterprise based in Singapore working to make behavioral and social science research accessible, inclusive, and transformative for all. Having earned her PhD in economics at Stanford University as an FSI Star Foundation Fellow, she is an award-winning trainer in behaviorally informed design and evaluation for policy and practice, holding leadership roles in serving various national and international policy and industry advisory capacities. Dr. Young, it's my absolute pleasure to hand the floor to you for this session.
Perfect. Thank you so much, everyone, for having us here for this panel at such an exciting event. It's truly a delight to be here at one of the, I think, most exciting conferences, bringing a very large number of stakeholders interested in this topic together. So being here virtually is a thrill. I can't imagine how exciting it must be to be there in person. So this particular topic, thinking about investment behavior, is something that as an academic and also as a researcher in the area of financial behavior and investor regulation has been very dear to my heart for many years. I think what we know, for those of you who follow sort of the economics literature, that as the development of economic thinking around finance has changed over the years to broaden to understand the benefits of looking at psychology and behavioral science beyond these very narrow paradigms of what we might think of as a neoclassical model of economic decision-making and cost-benefit analysis that's driven by all of these principles around what we might think of as traditional economics. And we really have seen a very quick progress from the Nobel Prize in Economics being awarded to Richard Thaler to today, where we actually see many different areas of behavioral economics starting to inform the way that we actually think about investor behavior in the markets. But what I think is really exciting and what we've seen in the last 10 years is the move from having this be purely an academic enterprise, where we start to think about these very theoretical constructs of how psychology, emotion, and framing change decision-making, to very practical incorporation of these on the part of advisors, on the part of regulators, on the part of people who are structuring the markets every day, and on some level as well, coming down to investors themselves who are becoming more aware of the fact that the way that we actually behave in the market, in reality, is quite different from some of the models that we've been using for many years, and that this has very strong implications for us, both in terms of investor protection, but also just in understanding where markets are truly headed in reality and not just on the page. It's been very interesting, I think, to see how industry has responded to this, and how we're actually, as a collective today, trying to take some of these insights about human behavior to all aspects of how the financial markets operate. And so I think in the beginning, when we began to say, look, what we understand is that people don't make decisions based on a cold cost-benefit, basis. We know that knowledge alone is important, but not enough. We know that access to financial services is important, but not enough. And we know that traditional regulation is not going to be sufficient to account for the fact that people are going to deviate from calculations that are based simply on what we think they know and what we think they have access to. And so our understanding of how investor values and preferences change over time and are mutable and are influenced by things like social effects, our beginning to understand that investor responses to information are very nuanced, very dynamic, and sometimes very incomplete in ways that can be affected by the tides of misinformation that we're seeing in the markets today. And then last but not least, the fact that people don't make decisions in a way that we might imagine based on paradigms that are driven by a lot of the theories and frameworks that we have been studying for many years, but really very often driven by heuristics, by rules of thumb, by emotion, by changes in the moment. All of these things today we understand are not just about temporary irrationalities, but really systematic biases in decision making that we have to account for. And that if we step back and we make our own practices shaped around how people actually behave, that's not just a nice to have, but actually critical to have, as we are entering a world where financial markets are more complicated than ever before, moving more quickly than ever before, and into the realms of new instruments that we've never seen before. And because of that, the scope, I think, for using behavioral insights and behavioral economics beyond our traditional models is greater than ever before, but also the risks are greater than ever before. For that reason, again, as I've said, one of the most exciting things for me in this landscape as an academic is to see this coming down into real world practice. And I'm delighted, therefore, to have with myself today on this panel 3 speakers who I hope will be sharing with us from their very diverse experience of the financial markets, their personal experiences and reflections on investment behavior in practice. And the 3 individuals I have with me today are Brian Zeng. Brian is the Chief Executive Officer of FA Advisory Sdn Berhad, which is a financial planning and advisory firm in Malaysia. Brian has been responsible for spearheading the strategic development and growth of FAA with over 19 years of experience in the financial services industry. And before this, Brian has worked as head of investment planning for 4 years at a boutique financial planning firm advising high net worth individuals. So we're hoping very much that Brian will help us understand where this is coming from a financial advisory perspective. We also have with us on the panel, Ng Ji Hao. Z is the head of the Retail Wealth Distribution Division of Manulife Investment Management. He also has over 20 years of experience in the financial services industry, covering asset management, banking, and life insurance. Previously served as the Chief Agency Officer in a multinational insurer in Malaysia and Chief Executive and Director at their asset management arm. And prior to this, he's also held several other leadership roles at leading multinational and local asset managers in Malaysia. And last but certainly not least, we have with us Mrs. Sally Wong. Sally is the Chief Executive Officer of the Hong Kong Investment Funds Association, which is a non-profit organization representing the asset management industry overall in Hong Kong. Sally also takes a very active role in investor education and research initiatives. She's a member of the steering committee on China Bond Index Experts of the China Central Depository and Clearing Company, and a core member of the China Aging Finance Forum 50. Sally is also a vice president of the Hong Kong Green Finance Association and the co-chair of the ESG Disclosure and Integration Working Group under the HKGFA. Sally also sits on various other committees, the SFC Committee of the Real Estate Investment Trust, the SFC Public Shareholders Group, and the MPF Guidelines Committee, as well as the board of the International Investment Funds Association. And she's previously also been a member of the Hang Seng Index Advisory Committee. So as you can see, we have 3 panelists with very deep experience across the financial sector. And I'm hoping very much that each of them today will share with us 5 to 7 minutes about their own reflections and experience of investment behavior. We're going to kick off today by inviting Brian to start us off. Brian, the floor is yours.
All right. Thank you, Dr. Joanne. Really a pleasure for me to be here, and thanks, FIM, for inviting me to share some of my experience. I think over the past 2 years, right, a lot has happened in our country and also around the world. But the interesting things is when we look at investors' behavior, not much have changed actually. What we still see, the prevalent biases that investors, including myself, that always come out is things like loss aversion, where one person, we really are very adverse to losses, meaning to say that a loss actually felt double or more painful than any certain gains around that when we do our investments. And also during the entire pandemic, what we have seen as well as another prevalent biases that we've seen is also status quo bias, where investors just maintain where they are and not do anything because they're in their comfort zones. What we have seen throughout the past 2 years is as the the governments of the world wanted to kickstart the economic, the interest rates. This was last year or the year before, was actually cut to very, very low. Even here in Malaysia, it was an all-time low of 1% in the FD rate. But we still see a lot of investors still keeping in renewing their fixed deposit or certificate of deposit with the bank, but they don't want to come out and invest in more risky assets. So all these things doesn't really happen during the past 2 years, but it has been the prevailing theme across my entire almost 2 decades of experience advising investors. So but there are ways that as I myself also learn the various skills, the various emotional or cognitive biases that an investor has, there are ways to mitigate this into a certain extent. And of course, I think later part in the panel we will discuss some of these things that we can do. But overall, talking about investments and like what Dr. Jen has mentioned earlier, in my sharing, I always like to use this metaphor. For those of you who are Star Trek key fans, right? You know that in the Star Trek series, there's this individual called Mr. Spock, who is totally no emotion. He only does all his decision by logical thinking, and there's absolutely no emotion. So that is our traditional finance. And of course, you know who's the captain of the Starship Enterprise? Captain Kirk. He's the one with all the passion, with all the let's go explore the real new world, right? So that is the emotional man. And within every one of us as human beings, right, we are not robots, so we have both sides. We were taught to be thinking about traditional finance in a rational way, but however, when we act and we make decisions, majority of the time we are following our emotional instincts. So this is, I think, the theme that the panel here this morning that we want to discuss about. What are the areas that we want to look into, and what are the areas how we can mitigate this? That's my short sharing, Dr. Jayan. Back to you.
Right. Thank you so much, Brian. And I really appreciate the Star Trek story. That's always a great way to start a conference. Absolutely right? And it takes two actually to drive the Starship Enterprise forward. And you can't have one without the other. But again, the driving force is Captain Kirk, and we are all there with you. Fantastic. All right. Let's move on and let's ask Z. Z, I understand that you have a sharing for us as well. So step back, and again, the floor is yours.
Yeah, thanks, Dr. J. And hi, good morning, everyone. I want to echo what some of the things Brian has said. And, maybe in different version, but, in not too many words. So all of us remember during COVID, the first time in my life that I learned about lockdown, all right? And the market, actually the investment market went down by 30% or so in a short 3 weeks. So the first phase of emotion that people were going through, if you remember, was a shock, panic, and sell everything they can sell, for example. And here comes the second level. The second level is the moment you're being locked down at home, you can't go out, you look out for news, you look out for what is COVID, how to overcome the fear. So the acceptance level kicks in. So that to me is the second phase. And then it went on to the third phase quite quickly, in the last experience, that people, realize that life goes on. People realize that, we have got to rationalize the market. And then in every country or in every versions in their environment, I can quote a Malaysian's example, I can quote a overseas example, but I'm sure you remember, many of us here remember, once you overcame the panic phase 1 and you accept phase 2 and you go into phase 3 that you rationalize things, what happened? You went after the glove stocks. In Malaysia, the glove stocks were flying. And then, here it came the overconfidence, the herd mentality was clearly shown during that episode. So, some other example, technology, everybody was going after the FANG stock. until today, we are still discussing about China, US-China trade. You felt so negative when you see your performance went down. And, for a moment, investors may forgotten their investment objective, initial investment objective, their time horizon, why they are doing this for. They don't pay as much attention to the low valuations now or the cheap valuations now versus the very high price paying a premium then. So it's either excessive risk taking or maybe excessive risk aversion. So we are here, speaking about theory and being practical. I thought I want to share a slide with you. So, can I get the organizer to enable me to share screens, if I can? Very quickly, I will show you some of my thoughts. So, to me, it's a case of inner struggle, very much so. Whether you are making very rational decisions or your emotions are influencing your decisions. So, over the last 20 years or so, when you see a crash, 1997 Asian financial crisis, 2008 global financial crisis, or the recent one, there are a lot of emotions. But even during the bull run, the bull market, there are equal amount of emotion. The more positive ones, but is the other flip side of the coin. And there are two key concerns when we speak about behavioral finance. You got all sorts of keywords, loss aversions, overconfidence, regrets, and the list can go on. But to me, there are two key things that is affecting you: procrastinations and inertia. And the pitfall, very simple. You may be ended up buying high and selling low. You are not diversifying enough. You neglect to rebalance your portfolios. You ignore the timeless principles of investing. So now, I know, some experiment has been done by some great people. So we have got two friends here, and you have got two bananas. So you gave the two bananas to the elder one. The elder one is going to be so overjoyed. And the moment you take one banana from the two bananas that is given to the younger one so that it's fair, one for each, guess what? The one that has just lost one banana is going to be going through a period of emotions, angry, agitated, whatever you can describe. But the young one is going to be very happy. So, people hate losses. It's not about being fair. It is, they just hate losses, any one of us. So, another simple experiments done by great people, a great piece of research. Number one, for gains, you are given option A and option B. Option A is 80% of probability you will win 4,000 ringgit. 80% of your probability of your chances of winning. Very good, 80%. 4,000 ringgit. What happened to the 20%? The 20% is you will not gain anything at all, zero for you for the 20%. So that was option A. And option B, I will give you 3,000, the investment will give you 3,000, you will make a positive return of 3,000. Between the two, which one will you choose? Well, the study, the research paper done by the great professional actually came out with the answer that 80% of the people went for option B. They want certainty. Investors prefer certainty. Even though the amount of 4,000 was offered with 80% chances of winning, they are not taking it up. They will go for certainty. 3,000, fine, I'm happy. However, if you look at the screen at the bottom, so this is about losses. So just now it's about gain, giving you 3,000 for sure, win, all right? But now it's about losses. The losses, okay, is now the same option A and option B. Option A, you have a 80% probability of losing 4,000. But you also have an equal 20% probability of losing nothing. All right, nothing, losing nothing. So will you go for option A or option B? The option B here is a sure loss of 3,000. Well, the study and the research paper shown that people will go for option A because option A give them some chances of losing nothing, but option B is a sure loss. So we know the conclusion is people just hate losses. So gaining and losing are two different things. All right. So let's talk a little bit about being practical. So for both investors and both advisor, so when market becomes volatile, get a meeting between the both of you. Get the meeting and define what is a concern. Is there any hope or is there no hope? Both of you anticipate questions and answers. Do some case study. Make it visual. Review the truth and consider the right actions. Less the emotion. All right. So there are plenty of risks out there, but you got to be very focused. Which is the most critical one that is affecting you? All right. And then from there, we know what is the current situation. How did we get here? We will refer you with many historical events. Has there been any reactions in the market? How deep? How long? How bad? What is going to happen next? What can we do about it? All right. Then, we will show you, something like that. COVID is a concern, but if you look at all the previous epidemics or pandemic, lives goes on after that. If you remember, you're investing for 3 to 5 years or longer than that, or for retirement, why do you look at 1 year performance? But even if you look at 1 year performance, the chances of winning is 74% versus a loss of 26%. But if you increase that 1 year to 5 years, your chances of winning is 86%. But if you are investing for retirement or for legacy planning, that is 100% winning in stock market. So, I got to do this to get the emotions down because the headline news is affecting the whole world right now. Okay. And maybe the last one for my slides. If you look at this, we have got chances of winning in a year and chances of losing in that particular year. So very quickly, if I can just look at the two extreme, 1997 Asian financial crisis. So what happened? That loss for that particular year was in between 40 to 60%. And 1998, if you can see it, 1998 was a loss of in between 0 to 20%. And 2008, global financial crisis. Oh, wow, very painful. My performance went down by maybe 40 to 60%. But the moment you look at the 97 and the 98, big losses, and you refer to your extreme right-hand side, 1999 was a big recovery. 2008 was bad. But if you look at the extreme right, 2009 is a big gain, a big loss, following that, a big gain. So, why let emotions disturb us so much. You know, be like captains. All right, that will make things very easy. Thank you very much. I shall pass the floor back to Doctor.
Thank you so much. Thank you so much, Sihao. I also actually really, again, appreciated this presentation, and I really like the picture of the monkeys and the bananas. It actually sort of, helps me segue a little bit into a discussion, just a little bit of a framing. I think one of the things you also pointed out is that there's a lot of jargon around behavioral finance. In fact, if you go online and you search, you will see that there are 200, 300 types of different biases that can affect us. So actually part of what we want to do to make behavioral finance more manageable and understandable, I think, as you have said quite rightly, is to boil it down to the basic biases that we're seeing affecting behavior, and then be very practical about how to manage that. And I think that's actually a very wise way to go forward, because we can also be overwhelmed by the different types of irrationality and biases until we don't really know what to do. So being very practical with these steps, saying, look, we recognize that there are many ways in which people can be triggered, but ultimately, let's focus on these things that we think move investor behavior very often, which is the procrastination, the inertia, the focus on loss and loss aversion. And then let's think about practical ways that we can make sure we keep framing back to investors the long term, the things that we know, the actual reality. We recognize that there's panic. Let's try to keep making sure that we frame back actual objective knowledge and keep people in the zone. And that's a very practical way, I think, to move forward in life, which is great. Thank you so much. I think what we want to do now is turn to Sally to maybe also give us a little bit of that perspective from where she sits, which is really, I think, from the international side, from the investor, from the asset management industry representation and advocacy side, and also the investor education side, to talk a little bit about, confidence, how we see these markets behaving. And then Sally, if you could also, I think, speak to us a little bit about nudges. We've already had a question, I think, in the Slido about people asking, okay, we know how all of these risks can arise from emotions and investing, but how can we use these principles to encourage more positive outcomes? So how do we, in some of the terms that we use, nudge people to do better? Sally, please.
Yeah, thank you, Joanne, and thank you for having me to join this panel. Very enlightening. And in fact, I echo very much what Joanne has just mentioned about how to frame the discussion in a more longer term perspective, because I think that's tied to one of the key biases, is the recency bias, is that people try to magnify and be very fixated on the recent events. And exactly, this is something that we are trying to inculcate amongst the general public. When we talk about pension fund, in fact, this year, the performance of our mandatory provident fund, which is the second pillar, you can say it's appalling. For bonds, for equities, even though it's globally diversified, they suffer major losses. And for many investors, they'll say, wow, why can't MPF, which is supposed to be much more prudent, is for retirement? If I invest in bonds, I suffer losses, in equities, losses. So I think what we have been doing, both the industry and the regulator, is that we try to frame people's perspective in a much longer term frame. As he has just mentioned, even in the past 2 decades, after each major, like say, adjustment in the market, we see a rebound in the following few years. So what's very important is to manage expectation, to let people understand that don't be fixated on what you see in the past 1 year, 3 months, or 6 months. That is not meaningful, because ultimately, for example, in retirement, the greatest risk is not short-term market volatility, but whether you can achieve an outcome that can beat inflation. If you look at MPF, the inflation in the past 2 decades is about 1.8%, and the annualized return, the net return, is about 2.8, 2.9%. So in that sense, we are able to outperform the inflation, which is the key objective of retirement investing. So what is very important is to upfront, we need to manage investors' expectation that there is definitely volatility. Don't be fixated on recent events. take a long-term perspective and try to do a way to structure your investment in a way that can achieve this objective and manage the risk. For example, a key message that we have been inculcating is that for young investors, if you have an investment horizon of 30, 40 years, what you should be focusing on is how you can best leverage on what the capital markets can provide to you. That is the upside. And that you are in a much better position. For example, if you are 20-something, you are in a much better position to invest a bulk, the majority of your portfolio into equity or growth assets. And then you start to de-risk when you grow older. So we provide the strategy, the frame, the factors that they should consider, and even with calculators. I think all these tools are very important because ultimately, this ties in other bias is that if you are going to explain to people something very remote, vague, they can never really translate into action. You have to provide them with tools that are actionable, deliverable, that they can sort of quantify or visualize what the outcome. Don't talk to them in vague terms. It won't work. It won't fly. And in particular, because for a lot of people, they'll say, well, I need to satisfy if I have a lot of immediate objectives goal and also immediate gratification. The self-control to be very disciplined and then put aside money for the longer term is very, very challenging. We are all human. Well, there are a lot of things that we want to meet and satisfy immediately. So, and this ties to other tools that is very, very important that we've seen in other markets, the nudge. And that is, you see in UK, for example, Nest, in other markets, US, they have this auto enrollment. That is, instead of really trying to preach people with a lot of vague concepts, the importance of retirement, just let them do it through auto enrollment. Of course, we can also provide them a choice to opt out. But the effect of this through auto enrollment, you can see in the UK example or the US, that is immediately the participation rate into the retirement scheme just jerk up to 80, 90%. Of course, there's more cohort, like 10% or so, that would like to opt out. But at least you can get the vast majority to go in to have this discipline because people are too lazy to opt out, just like they're too lazy to opt in. So we leverage on this laziness and get people in. And okay, if there are people who really want to be proactive to opt out, okay, but that would be a small cohort. At least we can be able to assure the majority of the respondents or the employees to do something first. And doing and acting is much more important than talking. And I think these are the tools that is very important. It's not just the auto enrollment, and then you can step up and have auto escalation, and you can build on that. But the most important point is take the first step, and especially important for retirement. With that, thank you.
Thank you so much, Sally. And I also really appreciated both of those examples, speaking about the auto-enrollment as well as the auto-escalation features. And I would also add that when we've looked at studies in the UK and the US, it's actually the most important constituency for this are young people. So when we actually see, the difference between auto-enrollment and self-enrollment, that once you become, 40, 50, suddenly you realize that, oh my God, I have to retire. So people do participate. But actually, those young people who benefit the most are the ones that are least likely to sign up. Because, let's be fair, when you're 20, are you thinking, do I want to sign up for my pension plan or I want to go out on Friday and have a good time? So the answer is, very rarely is it, I'd like to sit around and discuss my pension plan. So when we do see that we have auto-enrollment, it actually does benefit these groups of people the most, because these are the ones that actually have the most to lose, actually, if they don't sign up, but for whom actually the saliency is so very, very little. And that's where we've actually seen a complete and radical and invisible change just by using these behavioral insights and principles. But at the same time, I think, as you mentioned, it's never a silver bullet. There will always be people who, for good reason, we want to allow them to exercise their choice to opt out. We don't have all the information about them sometimes. And at the same time, also, we have to allow people some autonomy. So one of the things I think that behavioral economics or insights tells us is that we can design these products to give people some choice, but we can still guide them towards what we think is a good outcome for the most people, not necessarily for every single person. So thank you very much for all our three panelists for sharing their initial insights. I think at this moment, what I'm going to do is I'm going to invite, I see we already have some comments in the Slido and some questions in Slido that I think actually have been addressed by some of what our panelists say. So I encourage all of you here to put your questions on Slido. Do post them. I will be sending them to the participants. In the meantime, what I would like to do is actually turn this question actually back to Brian. So Brian, I think could you share with us actually some examples of how we've seen behavioral finance principles used to encourage more positive outcomes, particularly when we see clients that have more particular biases such as very inappropriate risk aversion behavior, or who have been in the past affected or burned by previous losses in past crises. How do we actually turn our knowledge here to helping our clients or achieving more positive outcomes?
Right. Thanks, Dr. Joanne. I think it's firstly, as an advisor, I'm speaking from an advisor point of view, how we help our clients to achieve their financial goals. It's very important to first distinguish between the type of biases, or let me just put it out here. There's two categories of biases. What we have discussed mainly this morning could be on the cognitive biases. Cognitive biases, meaning to say that biases that are related to information. Right, it could be lack of information, it could be misleading information or things like that. So that part, if it's a cognitive bias relating to information, is much more easier to mitigate. All we need to do is give them the right information, give them the relevant information, like what Zahao has mentioned. Just give them the past track record, over 3-4 decades, what has happened to the stock market. So these are information that can be shared with the investors so they can make a better decision. Now, on the other side of the spectrum, what we have are emotional biases. Like what Dr. Joanne, you mentioned just now, they may have got burns, in the 1997 or 2008 financial crisis, and they will never buy any stocks again. Or there could be certain reasons during their developmental stage, during their childhood, that they have a different experience with money. And that could also very well impact the way that they invest. Now, emotional biases generally are much more difficult to mitigate. So what we do as an advisor is we will try our best to adapt to the client's emotional biases rather than try to change their biases. So when we look at these two parts, we also look at another thing is called the level of wealth. Right. Of course, if you are more wealthy, you are at the higher level of the society, you have more assets, right? It is definitely much more easier to adapt to the client's biases rather than we tell them, you must do this, you must do that, right? Because they have the high level of wealth, they can take on more risk, they can take on more adaptation to their portfolio. However, for those who are in the lower risk category, we'll have less flexibility to adapt. Because if we adapt, for example, if this person is really risk averse, doesn't want to go into stocks, just want to keep money in the bank, then if we adapt to them, then is very high chance that they can't reach their financial goals. So we have to look at these four main factors and try to find the sweet spot. Of course, if it's cognitive, like I said, continue to educate them. If it's emotional biases, we try to understand. And we try to link it to the meaning, to why they want to invest in the first place, and why, what are the consequences if they don't, right? So this is how we approach it. There's many factors, there's many things that we really need to look at, but I just want to leave it here that these four things that we need to look at. And overall, as an advisor, we have to start with the awareness, with the skills, and how we get our investor in going through to navigate all these biases.
Great. Thank you so much, Brian. And I think that also addressed one of the questions that came up in our Slido, where I think one of our audience is asking, it's our nature to be defensive in the face of uncertainty or danger, but isn't it so hard to change something that is by nature? And I think your response really highlights that. Firstly, some of these things we have to understand. I think there is a quote that says, give me the wisdom to change what I can and the wisdom to know the difference between what I can change and what I can't. I'm madly misquoting that, but basically part of it is not trying to alter the fundamental of human nature, particularly things that may be set in someone's ways from some underlying events that are very fundamental to them. And so part of it is also understanding where that comes from and the fundamental, and working around it to try to put it in context as well. So we don't necessarily want to make everyone into a perfect, rational robo-investor. And that's not a feasible thing. And it's also not achievable for us. It just leads to a lot of frustration and I think time wasting. So of course, giving information where it's necessary and having the knowledge of how to do that, but also having the sensitivity and empathy. I think here's when people also say that to be an advisor is an art and a science. So there is some of that art as well. So thank you so much, Brian. Z, I want to actually ask you one of the questions that's coming up here. I think you've spoken actually quite at length about the things that you've seen in the markets and historically what you've seen in the markets. But one of the questions coming up in the Slido is, what are actually the common traits that you are seeing in Malaysian investors specifically? And perhaps if you could say, going forward, what kind of traits you might see, relative to the framework that you've kind of laid out already, just looking at Malaysia specifically.
Thanks for the questions. I'm not able to tell certain traits because everyone can be quite different. If you want me to compartmentalize, I will try. However, just now I introduced two keywords, and I say it's about procrastination and inertia. And now I give you two simple keywords that will always happen. Are you managing your greed, or is there a need to manage your fears? So is it a greed or a fear thing? For that, I would like to call the next word, to call out the next word. So be it the greed or the fear in the market or in the environment, just remember one thing that is even more important than financial gain or loss. Go back to the motivation. Everybody starts with a motivation, something that is obvious to many, but it may not be obvious to everyone. We are doing something because of we are doing it for ourselves, for our future, for our kids. What is the motivation? So I think that is important. Number two, instead of speaking about the traits, I think among Malaysians, specific to your questions, or outside the scope, I think trust can be built and trust can be managed, be it an advisor or a customer. So how do you do that? How do you build trust? I'm so fearful. I think it's a factor of being consistent. I speak very consistent, so people like to invite me to speak. And experience, I think that is important. Goodwill, what kind of reputations you have, whether you are in a professional company or you are running a professional firm. Last but not least, time will tell. Hopefully not too long, but time will tell. So, go back to the motivations. Remember the motivations. Remember the why. Why are you doing that? Yeah.
Right. Thank you, Z. I think that's also a very timely thing where we talk about, our client behaviors, but actually if our own behaviors actually mirror this, our commitment to long-term, our commitment to being rational, and we actually build that in very strongly into how we interact with clients. We ourselves can demonstrate that our behavior is not come here, come there, influenced by all of these things. And that's actually a very important part of building that ecosystem as well. So thank you very much for that observation. I'm going to move actually on to Sally. Sally, you spoke about auto enrollment, and you also talk about auto escalation, which actually brings people into our systems. And then actually auto escalation, you might not think that today you can save, but tomorrow you can save, and so that helps us to build the foundation for accumulation. One of the questions for the floor actually is asking about other aspects of this process. So when we talk about onboarding clients or new investors coming into it, or basically not new to the markets necessarily, but new to ourselves or new to a practice, how can we also, what are some things that we can also do to talk about how we might use some of these insights in the process of bringing people on board?
Yeah, thank you. I echo what C has just mentioned about this confidence, this rapport between the advisor and the client, because as maybe aware that there are different types of buyers, ranging from overconfidence and other factors that will shape how they see the whole thing. And very often, if we take what the behavioral finance experts have been talking about, the system 1, system 2, very often they take a more intuitive approach, make snap decision, but at the same time, it's very much conditioned by the system 2 that goes through a more thoughtful process. And so it's how that will shape how they approach investment. This will shape how the investors will see, for example, what is the proposition of this investment, the trustworthiness of the investment advisors. So I think there's a need, first of all, to really deep dive to understand where they are coming from, because when they come up with some sort of decision or that probably would already be shaped by something more deep down inside, which other panel members have said. I would like to take one example, overconfidence. This is something that when we do focus group discussion amongst investors, like say, typically we focus on funds. On that, they probably tend to be more humble and say, oh, we don't know much about funds. But every time when you talk about stocks, suddenly all of them become experts. And they will share with you, oh, how good I've been doing in one particular stock, and at what point do I come in? I've got a lot of information. And so this probably is a good example to highlight the overconfidence in terms of the ability to really interpret information and the quality of information. But if you deep drill into that, you'll find that in the whole portfolio, when they talk to a Brad about the success, 1 or 2 stocks only is a small percentage of the whole portfolio. They try to avoid talking about the losses. And this loss aversion is something, or this overconfidence about the ability to interpret information, the quality of information, is something that is quite prevalent when we talk to investors. And I think ultimately you need to understand the different sort of bias, how they affect their behavior, and how we can provide some tools to give them comfort and let them understand that the investors or the financial advisors are knowledgeable, timely, can be trusted, and that they can really rely on, rather than just to be overconfident amongst themselves on something that is not really well-based.
That's great, Sally. So part of what we can do is actually, when we bring people on board, it's not just about the demographics, but really trying to understand some of their behavioral subtypes or some of the biases. And I think Brian has also made this point that there are so many different biases that people have that it is actually really very complex. We shouldn't typecast people based on 1 or 2 things. This process of getting to know your client during the onboarding, as well as conveying, I think that the expertise and the nature of that relationship, all of that is a really important thing to do actually, and as you mentioned, at the beginning of that relationship, I think that's a very crucial time. Also, just from a psychological perspective, because that in that new period is when a lot actually of our information is being cemented. A lot of our first impressions matter so much. The client's emotional response at the beginning is also so important, and it can set the tenor for a whole relationship. So that onboarding period, getting to know them, and of course, as you say, because of overconfidence, really getting to know them, not just what they say or how they feel about themselves, because that also may not be accurate, but really trying to get under the skin. Okay, I know we only have 10 minutes left. I know time has really flown on this panel, and well, so we are actually at I think we have just a couple more questions from the floor, and I'm going to just try to bring them all into sort of like a closing remark, and I'm just going to ask our panelists one by one to actually share their reflection on the panel. What do you think? And maybe I'll go in the order of which we've been speaking. What would you think actually is your primary reflection on, how should we take responsibility for behavioral, for what we know from behavior, right? And we're all coming from different aspects: individual investors, advisors, regulators. Who takes responsibility for this? What do you think, reflecting on this, is the best way forward for us to take this and put it into practice? And Brian, maybe I'll leave this to you first. What are your closing thoughts, and maybe just a couple of minutes?
All right, sure. I think to summarize what we have discussed, which is only just a tip of the iceberg, from the advisor's role or point of view, it is very important for us to have that initial understanding, that chat with the client. So we have moved from just having plain structured financial planning questions and to more financial coaching type of relationship, where from the onset when we meet our clients, we ask probing questions like, what's your relationship with money? How would you like us to help you? In what areas would you like to make improvements? What does money mean to you? So we probe to all these kind of questions to try to solicit or bring to the surface the underlying motivation, like what Zehao has mentioned, the underlying motivation of this person wanting to meet us, wanting to do something about their finances. It could be a certain pain that they're currently facing, or it could be certain aspiration that this person wants. So we work alongside that. It is more on a advisory relationship rather than just pushing a product. This is the product with the best 10-year record, or this is the funds with the highest conviction team, or something like that. We go through understanding, building that rapport, building that empathy with the client, and that is where we are able to get the most working relationship out, and that is also where we can get the most cooperation from the investors in the days and the months ahead. I think that's a very quick remark for me. I think it summarizes how we can make use of all this information that we know, and to really genuinely go out there, speak to our clients, and help them to achieve what they want via investing.
That's great,
Yeah.
Brian. See?
If I can just add on, I think all of us as individuals, we want the best. So, we want the best investment, we want the best for ourselves, and we want the best health, tip-top conditions, be healthy. So we want it. So who is responsible for it? I have got some bad habits. I want to be healthy. Every day I say to myself, I want to be healthy, but I've got some bad habits that I don't think I exercise enough. I think I love high cholesterol food. So I try to manage it, but sometimes I just lost it. So who's responsible for it? Speaking about COVID, I've got people telling me to do a self-test is scary. To go for a medical checkup is scary. I don't want the bad news. Okay, so it's behavioral. But who is responsible for that? Of course, a lot of parties are responsible for it. You yourself, your family, your advisor, and even for platform like today is, SRO, organizing this educating public and the players in the market. So, I heard a lot just now about auto enrollment, and I agree with that. So if you want the best for yourself, you want to be, very healthy, auto enroll, people say, buy the most expensive sports gear, then you start exercising more. Enroll yourself into the most convenient gym, pay for it, pay for your gears, then you will go for it, and things like that. So I think in our industry, for me, it's about don't pay attention to something that is really too short term, because we are here, doing diversifications, doing a portfolio rebalancing, doing a regular savings plan, planning for retirement. I have my investment in unit trust, in mutual funds, in PRS, and I don't look at it seriously. I don't look at my own balances, statements, and accounts, because I know what I'm doing. I'm doing for my 15 years daughter. So I really don't log in and look at my own accounts. Is it a good practice? May not be, but that is because I'm in this field. I know exactly what I'm doing, and I remember some part of it. I just don't monitor. So over the last 2 days, I came back from Langkawi with a group of colleagues, and certain conversations were very interesting. So one colleague said, some of our investors are behaving not the same way versus their own durian plantation. Because for them to own the durian plantation, they know it takes about 10 years for harvest. But when it comes to investment, they don't talk about the 10 years. They talk about what happens this year or next year.
Yeah.
And the other very interesting topic that my colleagues are saying to some of us, and it goes like, do you know the global equities now is going for a global discount, and it's a huge discount? I say, yeah, but not everyone will understand it. All right, thank you.
Okay, thank you so much, Z. And I will, after my closing remarks, I'll say something. But if you have friends with a durian plantation, why not share?
Yeah, sure.
This is a very important piece of information. Sally, could I ask you for your closing thoughts?
Yeah, thinking about durian, just very much look forward to going to a durian plantation. Well, my final thought is not so much a thought, but a question for everyone to think about. Maybe a bit provocative, but when people say that to overcome biases, we can have different tools. We talk about escalation, auto enrollment, and all those. And also, for example, providing more investor education and as well as simplification of information. But I'm also thinking about the trend that we are seeing in the market is that now with more and more providers providing digital means, the mobile means. On one hand, they're very good because very user-friendly, very simple, very user-friendly that people can make use of. But at the same time, because of focusing on the simplicity, very often they're putting in a frame that I'm not sure whether at the end that would necessarily be the best interest of the investors. For example, on the screen, they just highlight the top 10 or top 15 funds or the best-selling funds or the top performing funds. And that very often investors, because it's so easy to click buy, sell, and that they will use that and that will set the frame for them to make a decision. But as to whether that is the most appropriate, so I'm just thinking when we say simplification of information, to what extent should we simplify and what exactly should we make use or make available in such a short space when people's attention span is so short? This is something that I just want to throw a question for everyone to think. I don't have an answer, but the more I think about it, and the more prevalent I see this sort of practice in US, Hong Kong, and other places, it's easy for people to make decisions. but ultimately, is that the most appropriate way? And just leave it for people to think about.
Well, I think that's a very, striking comment to end the session on, because I think it highlights that, technology is moving us forward. On the one hand, it allows us all of these new ways to think about doing better, but it opens these new risks. So it enables instant gratification. That's problematic. And it also enables overconfidence, because sometimes you get a quick win, and it gives you that hit of adrenaline, and you're like, oh, let's go forward. So technology, I think, is neither sort of good nor bad. In a way, it enables our better selves, but it also enables our worse selves. I think one of the great themes that I've heard throughout this panel, and I really appreciate everyone, is that one of the biases that we often have is something called projection bias. And it is the tendency of advisors and experts to just believe that the person on the other side knows everything you know. So they think the way you think. So you just tell people what you think is good for them, and that will fix them. But what I've really heard on this panel is actually really, three very thoughtful stances into saying that's actually not what we want to do. We want to go forward by really going back to what is actually underlying people's decisions. And, just in terms of why we do what we do, all of us have these higher order thinking selves. I think as Sally mentioned, our system 1, but under it, we all also have our system 2, our emotional selves, our triggered selves. These are things that coexist side by side. And again, the way that we go back and forth between them means that we are able to think rationally, but we are unable to control all of these impulses. And that's just a factor of human life. But what I really enjoyed in this panel is how I think everyone talked about coming back to the basics of why we invest, understanding that that's a challenge, understanding that people are fearful. And I really liked very much Z's remark here, which is that we want to move, and I think also something that Brian mentioned, we want to move as we have always moved, from being very product-centric to being very client-centric. And so this idea, I think I want to close the panel by saying this idea of investment behavioral insights is actually just an extension of that, being deeper and richer understanding of what does it mean to be client-centric. And the idea that we are not selling products, we are trying to coach people towards their own better intentions. So I mean, not to reveal my own football preferences, but you never walk alone. That's what we want people to take away from this. And I think that's a really fantastic note for us to end. Technology is not enough. Financial education will never be enough, but together we can do better than where we are today. So thank you very much. It is exactly 12:01. So I would like to thank all three of the terrific speakers and return the session to our Master of Ceremonies. Thank you all so much for your attention.
Thank you very much indeed, Dr. Joanne Young. I suspect you are Malaysian, simply because of what you touched on durians earlier. We'd also like to thank you for touching on the topic of technology, which we will indeed be going deeper into in our panel session right after lunch. So once again, we'd like to thank our wonderful moderator earlier, Dr. Joanne Young, as well as our esteemed panelists, Brian Zeng, who is here in person, Sally Wong and Ng Si Hao for their valuable insights today. It's nice to have been able to cover both sides of the spectrum as well this morning, from a more macro discussion on an industry level over our first panel session this morning, and having moved on to a more intimate working level discussion around client and investment behavior. All right, it's time to move on, ladies and gentlemen. It's a bit of fun now. We have an exciting opportunity for you to win some prizes today. We have a simple pop quiz live. All you have to do is to follow the instructions on your screen. Now, we just need you to sign in using another device that's separate from the one you're using to stream this conference. So you can use your mobile phone or another device. As you can see on screen, log on to www.kahoot.it and follow the instructions that will be popping up on your screen. Right? So you see a QR code over there. You can also scan the QR code, and you see a game pin as well. Key in that game pin that will show up. Kindly key in the email address that you registered for FIMMAC. And key in your full name, please, instead of a nickname, so that we can identify you clearly. There we are. All right, we've got Meekly, Chi Keng, fantastic. Yes, join in ASAP and as soon as you can, because once we start the game, you won't be able to join further. Wonderful. Gentle reminder again, your accurate email address as well as your full name, not your nickname. This will make it easier for us to identify winners. All right, ladies and gentlemen, you stand a chance to win 300 ringgit cash over this pop quiz. This cash will be won by 2 people this round. And this pop quiz is open to everyone except for the participants of the ongoing Champions League game. So don't worry, if you're not already in the running for the Champions League, you can still join. And don't worry as well, to the Champions League players, you'll have your chance later this evening at the end of today to play in the Champions League. Wow, I see some familiar names here. I also see another Anita. Hi. We're going to be keeping the window for people to join in for just a little bit more. We're at 343 participants so far. We'll get as many of you in as possible. Don't forget to also key in your answers in the fastest time possible, because how Kahoot works is that it's an algorithm of a combination of correct answers in the fastest time. We are closing registration. Are you ready? Let's go. For our first pop quiz of today, blank is income set aside for unexpected expenses. You have about 30 seconds on the clock. Well, 60 seconds. Now it's down to 45. Starting off with the easier questions. Hopefully you get all of this right. Oh, we've got 350. Come on, put those answers in. 20 of you have yet to answer in 20 seconds. Indeed, correct. Most of you got that answer correct. Savings. Which of the following phenomena is unlikely to be caused by herd behavior? Don't forget, the quicker you answer with the correct answer, the higher you score. Not sure, just tembak ni. correct answer is indeed increased sales of iced tea on a hot day. Yeah, lah, that's external, right? That's weather. Okay, moving on. Which of the following may not be the proper way to overcome greed and fear in the market? May not be the proper way. We're still on the easy questions here. "20 seconds on the clock." Wow, I think our participants have only dwindled to 320. Correct, following the market trend. Well done. Blank refers to a good made in another country and brought into Malaysia. If you guys don't get this right, I don't know if you should even be attending this convention. You can hear how fast the blips are coming in. Bonus question, this one. Go for it, go for it. This is on the Malaysian perspective, okay? What is this good called? Time's up. Well done. Imports. Conventional theories presume that investors blank, and behavioral finance presumes that they blank. It's a bit tricky, this one. Take your time. The faster you get the correct answer, the better it is for you. Don't mind the suspenseful music. 3 seconds on the clock. Indeed, conventional theories say that we're rational. All right. Looks like that was the last question. Well done. Third winner is To Siu Hui, but congratulations to the runner-up, Lee Wei Ming. And Lively Wallaby 34. Congratulations to both Lee Wei Ming and Lively Wallaby 34. Congratulations. You win 300 ringgit each. Lively Wallaby 34, you might actually want to put your full name in next round, because then it's easier to contact you to send you your cash prize. All right, for those of you who didn't win this time, don't worry. That was practice round for you. You have another pop quiz coming up at the end of today, as well as another chance to win at the lucky draw, also 300 ringgit cash prize. All right, okay, speaking of lucky draw, you will have to enter the lucky draw quiz in order to qualify for the lucky draw. So only those who get all 10 questions correct will be put into the pot for the lucky draw. Timing does play a factor as well. So the faster you are in putting in the correct answers, the more likely you are to be able to join the lucky draw. Make sure you answer as soon as you can, as the cutoff time for the lucky draw quiz is at 4 p.m. It's an ongoing thing. All you have to do is to go onto the virtual platform on your page and click on the game section, and you'll see the lucky draw quiz over there. Also, take the opportunity to go to the virtual platform, and next to it, you'll see a survey button. So click on that, as well as you'll have a bit of time this afternoon in between sessions and over this upcoming lunch break to kindly fill in the survey so we know how we're doing and so we can serve you better in the future as well. Ladies and gentlemen, it is now indeed time for lunch. We will be resuming this convention at 2 p.m. sharp. So you have a nice, lovely 1 hour, 45-minute break. Come back, refuel yourselves, and get excited, as we'll have more engaging panel sessions, 3 specifically for the rest of this afternoon, and indeed more exciting opportunities for you to win more games and win cash prizes at the end of the day. So make sure you get back, and don't forget to click on next session as well after each of your sessions when you return. With that, thank you very much, and see you at 2 p.m.